Hello and welcome. The future of UK base rates in 2025. What are the experts predicting and what does it mean for you? Welcome back to the channel. I'm Paul Welch and we're here to make sense of the financial world. And today we're diving into one of the most important financial questions I'm currently being asked, and that is what's going to happen to the UK base rate next in 2025. Well, the current base rate is 4.75%, and this impacts everything from savings and borrowing. This looks at your mortgage payments, your savings returns, and even the stock market. But here's the real question. Will rates drop dramatically in 2025? Very good question. Some predict it will, and some remain stubbornly high. I spent hours analysing the latest predictions from top financial heavyweights: Goldman Sachs, Deutsche Bank, HSBC, JP Morgan, BlackRock, Barclays and more. I'll also reveal the exact dates their forecasts were last updated, so you know how fresh these predictions are for you. So whether you're a homeowner, a saver, an investor, grab a coffee or a cup of tea or something a little bit stronger, and let's jump right in. Before we dive into predictions, let's have a little bit of a recap. Base rate right now is 4.75%. Think of it as a financial thermostat of the UK economy set by the Bank of England. When inflation runs too hot, like it has for the past 2 years, the bank raises rates to cool it down. But when growth slows or risks of recession loom, they cut rates to encourage borrowing and spending. And this is kind of critical to where we are right now. Inflation has eased from its peak, but economic growth is sluggish, barely scraping by at 0.3% in the last quarter. The Bank of England faces a delicate balancing act: keep rates high to prevent inflation from coming back, or cut rates to stimulate growth. Now let's dive in to what the banks and other financial institutions are predicting in 2025. Here's where things get really interesting. Each major bank has a slightly different take on where UK base rates are heading in 2025, based on their assessment of inflation, growth and global trends. Goldman Sachs predicts the most aggressive cuts of any major bank. They expect the base rate to drop as low as 2.75% by late 2025, arguing that inflation will continue to cool and the Bank of England will prioritise boosting economic growth. In their own words, the current rate of 4.75% is overly restrictive for a slower economy. Deutsche Bank, in their November 2024 report, forecasts a more cautious drop to 3% by early 2026. They highlight concerns about wage inflation remaining sticky, which could make the Bank of England hesitant to cut too aggressively. HSBC, as of their September 2024 update, takes a middle ground approach, forecasting rates to stabilise at around 3.5% by the end of 2025. They describe this as a balanced strategy that addresses inflation without overly stifling growth. JP Morgan aligns with a market consensus that approximately 3.75% by late 2025. This reflects what most bond traders and economists expect. BlackRock, which last updated in August 2024, anticipates a moderate reduction to 3.5%, citing easing inflationary pressures and a return to economic normalization. Barclays, on the other hand, their forecast updated in October 24 predicts a gradual decline to 3.25%, reflecting concerns about slow economic growth and the need for careful adjustments. UBS in November 2024 projects an optimistic drop to 3% by mid-2025, driven by weak consumer spending and faster than expected disinflation. Schroders, with their update in September 2024, is among the most cautious, forecasting rates could remain as high as 4%, pointing to concerns about entrenched wage inflation and potential global market instability. T. Rowe Price updated in October 2024 that they expected rates to hold slightly higher at 4%, reflecting the Bank of England's possible focus on controlling inflation over aggressive rate cuts. BNP Paribas, which they revised their reviews in October 2024, predicts rates will align with market expectations at around 3.75%, highlighting global central bank trends as a key influence. As you can see, These predictions vary wildly. From Goldman Sachs' bold call for 2.75% to Schroders' more conservative at 4%, even a 1% difference in the base rate could have massive implications for mortgages, savings and investment markets. So why do these predictions differ so much? Let's break it down. Inflation remains the number one factor driving these predictions. Although it's easing, it's still above the Bank of England's 2% target. Banks like Goldman Sachs are optimistic that inflation will drop significantly, while Deutsche Bank and Schroders worry that wage growth could keep price pressures higher for longer. With economic growth, the economy is weak, with GDP barely growing in 2024. Banks like UBS and Goldman Sachs believe this will push the Bank of England to cut rates aggressively to avoid a recession, while others think the bank will tread carefully to avoid reigniting inflation. The UK doesn't operate in isolation. The Federal Reserve in the US and the European Central Bank are both expected to cut rates in 2025. If they do, the Bank of England may follow suit to remain competitive and prevent the pound from strengthening too much, which could hurt UK exports. It's a very delicate balancing act. Cut rates too much and inflation might come roaring back. Keep them too high and the economy could stagnate further. That's the challenge the Bank of England faces heading into 2025. Well, let's talk about what this means for you. Homeowners, if you're on a variable rate mortgage, a lower base rate could save you hundreds of pounds a month. Fixed rate deals might also become more competitive, so it's worth reviewing your options today. Savers, unfortunately, lower base rates mean lower returns on savings accounts and ISAs. If rates drop to 2.75%, expect interest rates on savings to follow suit. Investors, lower rates often boost the stock market as borrowing costs fall and businesses see higher profits. However, bonds could become less attractive as yields decline with falling rates. The key takeaway? Whether you're a borrower, a saver or an investor, staying informed will help you navigate these changes in 2025. So how can you prepare for these changes? Review your mortgage options now. If you're nearing the end of a fixed rate deal, start shopping around for new rates. This can begin now and cover the next and first 9 months of 2025. Fixed rates could get cheaper in 2025, but swap rates, which were 3.5% before the budget, are now above 4%. This means that the market is expecting a newer low of around 4%. Diversify your savings. Consider premium bonds or low-risk investments to offset shrinking returns on traditional savings accounts. Invest strategically. Focus on sectors like technology and utilities, which often benefit from lower rates. Stay flexible. Keep some cash liquid for emergencies, as rates could change slower or faster than predicted. So, 2025 will be a pivotal year for UK interest rates. Will Goldman Sachs' bold prediction of 2.7% come true, or will Schroders' cautious 4% be closer to the mark? Whatever happens, staying informed and being prepared is the best strategy. My own personal opinion right now is that before the budget, which has then been perceived to be inflationary, swap rates, which was banks trade money which impact savings and borrowers, were trading at around 3.5%. Now we're looking at a 4% trade for 5-year swap rates. And if the budget is more inflationary, then I don't see base rate dropping to below 4%. If the economy really slows and we look like we're entering into a recession, then it could drop lower. But I don't personally see 325, 275 or any of those rates today. If you found this video helpful, hit the like button, subscribe to the channel and let me know in the comments what's your prediction for base rate in 2025. Thank you for watching as always. Your support means a lot to me.